Imagine a company so influential that it manages over $11.4 trillion in assets. To put that into perspective, this is more than the combined GDP of Germany, India, and the United Kingdom. Yes, you heard that right. One company managing more assets than the total economic output of 3 of the world's largest economies combined. Today, we peel back the layers to reveal the narratives you don't know about BlackRock. BlackRock's influence is vast and far-reaching. With shareholding in major companies, their involvement in major businesses allows them to play a role in shaping corporate strategies. But how did they grow to this size and influence? Founded in 1988 by Larry Fink and a team of 8 partners, BlackRock started as a risk management and fixed-income institutional asset manager. Over the decades, it has grown into a financial titan, influencing markets, economies, and even government policies. Their journey from a small firm to a global powerhouse is a tale of strategic acquisitions, innovative financial products, and an unrelenting drive for growth. From a modest office in New York City, BlackRock's headquarters have transformed into a bustling hub of activity. Analysts and executives make decisions that ripple across the globe, shaping the financial world in profound ways. BlackRock's influence extends beyond their managed assets, as their investment decisions have the potential to impact financial markets and corporate strategies. Consider the impact of their decisions. When BlackRock moves, markets react. Their investment choices can drive stock prices up or down, influence corporate strategies, and even affect national economies. This level of influence means that BlackRock doesn't just participate in the financial system, they help shape it. BlackRock's reach extends into various sectors, from technology and healthcare to energy and consumer goods. Their investments can play a significant role in the growth and development of industries. For instance, their significant holdings in tech giants like Apple and Microsoft give them a say in the future of technology. Similarly, their stakes in major pharmaceutical companies influence the direction of healthcare innovations. Moreover, BlackRock's influence isn't limited to the private sector. They also play a crucial role in public policy. Through their advisory services, they provide guidance to central banks and governments worldwide. This dual role as both an investor and advisor allows them to shape economic policies, further solidifying their power. At the core of BlackRock's empire are their index funds and ETFs. These products allow investors to own small pieces of many companies, promoting passive investing and reducing risk. While this sounds ideal, there's a hidden side. With a significant presence in the market through their index funds and ETFs, BlackRock's investment choices can potentially impact market trends and corporate behaviors. When BlackRock buys shares in a company, they gain voting rights. These votes can sway decisions on everything from executive pay to environmental policies. It's a subtle yet powerful way to shape the corporate landscape. Think of the last major corporate decision you heard about, perhaps a merger, a change in leadership, or a new strategic direction. BlackRock's significant investments allow them to play a role in major corporate decisions, which can align with the overall objectives of their diverse portfolio. It's a matter of strategy and influence, where decisions have far-reaching effects. Consider the implications. BlackRock's investment in a company can signal confidence to other investors, driving up the stock price. Conversely, divesting can cause panic and sell-offs. This ability to influence market sentiment gives BlackRock a unique position of power, one that they wield with precision. BlackRock's dominance in asset management also raises concerns about market stability. Their vast holdings mean that any significant move they make can create ripples across the financial markets. For example, if BlackRock decides to sell a large portion of its holdings in a particular sector, it could trigger a market downturn, affecting millions of investors. BlackRock holds significant stakes in numerous companies. This grants them significant voting power in corporate decisions. As a small investor, you might hope your voice will be heard at the annual shareholders meeting. But in reality, your vote is just a drop in the ocean compared to BlackRock's influence. It's a subtle yet powerful way in which BlackRock shapes the corporate landscape. In boardrooms across the globe, executives discuss the future of their companies. A representative from BlackRock might sit quietly, their presence a reminder of the power they hold. When it comes time to vote, BlackRock's influence may significantly impact outcomes. This isn't just about financial returns. It's about shaping the world we live in. From environmental policies to labor practices, BlackRock's voting power can influence a wide range of issues. This illustrates that in the world of finance, significant influence can reside with those who hold substantial voting power. Consider the broader implications. When BlackRock supports or opposes a corporate policy, it can set a precedent for other companies. Their stance on issues like climate change, diversity, and executive compensation can ripple through the corporate world, influencing how other companies operate. BlackRock's voting power also extends to shareholder resolutions, which are proposals submitted by shareholders for a vote at the company's annual meeting. These resolutions can cover a wide range of topics, from environmental sustainability to corporate governance. By supporting or opposing these resolutions, BlackRock can influence corporate policies and practices. For example, BlackRock has been vocal about the need for companies to address climate change. They have used their voting power to push for greater transparency and accountability on environmental issues. This has led to significant changes in corporate behavior as companies strive to meet the expectations of their largest shareholders. The concentration of corporate equity among the top 1% is a growing concern. BlackRock's significant presence in the market exemplifies this trend, raising concerns about how the concentration of wealth and power may affect the economic well-being of a broader population. The notion that what benefits shareholders automatically benefits everyone is being questioned. Some analysts suggest that such concentration could be linked to wage stagnation and the potential for less competition in industries. Consider a small town where a single factory is the main employer. In this scenario, the factory owners, possibly influenced by pressures for higher profits, might consider cutting costs through reduced wages and benefits. The impact on the community is devastating. Families struggle to make ends meet, local businesses suffer, and the town's economy falters. This scenario can be observed on a global scale, as large asset managers like BlackRock may influence corporate decisions that prioritize short-term gains, sometimes at the expense of long-term stability. It's a reminder that the concentration of wealth and power can have far-reaching consequences, affecting not just the financial markets, but the lives of everyday people. Moreover, the concentration of corporate power can reduce competition and innovation. When a few major companies dominate an industry, smaller firms may face challenges in competing effectively. This can stifle innovation and limit consumer choice, leading to higher prices and lower quality products and services. BlackRock's influence isn't confined to the financial markets. Their extensive connections with government and financial institutions enable them to navigate regulatory environments effectively. This isn't just about protecting their business. It's about shaping the rules of the game. Through engagement in the regulatory process, BlackRock operates to remain a key player within the competitive financial landscape. For example, during the 2008 financial crisis, BlackRock was engaged by the U.S. government to assist with managing the fallout, which illustrated its role in financial crisis management. They were tasked with overseeing the assets of failing financial institutions, giving them a unique position of power during a critical time. This relationship has continued, with BlackRock providing advisory services to central banks and governments around the world. This influence extends to international organizations as well, where BlackRock's executives often participate in key discussions on global financial policy. As we draw our exploration to a close, it's clear that BlackRock is not just another financial firm. It's a titan that wields extraordinary influence over the global economy. Managing a staggering $11.4 trillion in assets means that BlackRock holds the reins of not just investments, but of entire industries and communities. Imagine a single company capable of swaying the decisions of big companies, influencing corporate policies, and shaping the economic landscape. Their investments don't merely reflect market trends. They create them. When BlackRock makes a move, the world watches, and its ripples can be felt in the stock market, corporate boardrooms, and even in the corridors of power where laws are made. This is a narrative that extends beyond finance. It's about how decisions made in the offices of BlackRock can impact climate initiatives, labor practices, and the very fabric of our society, as they guide major corporations and advise governments. And since you've stuck around to the end of this video, it's clear that you found this topic intriguing. If you enjoyed this deep dive into BlackRock, I think you'll definitely want to check out the videos popping up on your screen now. They explore even more fascinating concepts that might just challenge your perspective. And if you enjoyed this video, make sure to like and subscribe for more videos that break down complex and foundational topics. Thanks for watching.